Okay, good morning and welcome back, everyone, to our Tuesday morning market outlook session. My name is Tony Zering. I'm the chief strategist here at Options Play, and we are starting off this week from the past few weeks on a bit more of a positive tone here compared to the last few weeks. We have equity markets effectively, at least the market cap indices, the S&P 500 and the Nasdaq 100, effectively pushing against all-time highs on the verge of potentially breaking out to a new double top, which would be a fairly bullish signal here for the US equity markets here. 5950 slash 6000 is the double top level that we have been testing here over the last 2 months. And the question for a lot of investors, probably more so than other times, is really, do we get a breakout, a sustained breakout that can really start the next leg of a potential bullish market? There are certainly at the same time are concerns. What if this simply breaks out, kind of fails, and then pulls back into the trading range? When we look at market breadth, it's not particularly strong here. However, if you look at just kind of general bullishness here of equity investors, at the moment, equity investors tend to be pretty pessimistic at the moment, which is, many times can be seen as a bit of a contrarian signal and actually a positive here for equity markets here right now. So, we're on close watch here this week to see if we can break out higher here, especially on some volume and push through that and actually start our next leg higher in terms of equities. Now, if you look at the Russell 2000, it's not particularly a strong indicator of what is likely going to be a breakout and on strong volume, a continuation higher here. You have a 50-day moving average sloping lower, and prices continuing to trade lower, higher, lower highs, and we'll see if we can put in a new lower low here. But a lot of indecision here from small caps that we'll see if that can break out here higher on small caps and see if that also at the same time aligns with equal weight S&P 500 index, which largely has also been at the moment stuck in a bit of a range and not anywhere near all-time highs just yet. So when we look at the market cap indices, meaning the S&P and the Nasdaq, we are on the verge of what looks like a potential big breakout here to start a new bullish trend. And that's after what has been a challenging few weeks and arguably a challenging few months, where equity markets have been virtually flat since the end of November. Now, we have had a strong rally into the end of November, so a period of consolidation, a period of catch-up is necessary and healthy for the equity markets. But I do want to remind that we haven't really gotten much catch up here from the rest of the market as a result of the consolidation period that we find ourselves in at the moment. Now, if you look at growth versus value, we continue to see growth kind of and value. We haven't seen growth outperform value here in the short run. So not one particular factor is not particularly outperforming here right now. Commodities so far is holding on to that support level as gold continues onto that 3,100 level here, and oils continues to stabilize at the moment. But high yield corporate bonds did make a new 52-week high here last week, which is a fairly positive signal here for equities, meaning credit investors are not concerned about higher interest rates, concerned about credit quality here at the moment, which is a tailwind for equities and a net positive for that potential breakout here for equities. You do have the VIX retreating back to kind of call it 2 month lows here around that uh, below that 15% level. It does remain still a little bit elevated considering the S&P 500 is effectively at all-time highs. Speaking to the fact that investors are Still a little bit weary about this rally and whether or not it has the legs to sustain a breakout and continuation higher here. But my expectation is that if you do see the S&P break out to new highs, we would likely see a continuation of the VIX back down into that 12, 13% level, which generally speaking corresponds better with markets being at all-time highs. You have the 10-year yield still remaining fairly elevated here, around 4.5% here. Interest rates is definitely one of the biggest headwinds for equities here at the moment. Bonds have found a bit of a bid here above that 50-day moving average. We'll see if that can continue and push yields further lower, which would be supportive here of that breakout that I was talking about here for equities. The dollar index has pulled back to this 107 support level here, which is a major support level. If we see yields continue to tumble, my expectations are for the dollar to continue weaken, which is going to provide more of a challenging environment for both inflation and the U.S. consumers' impact on tariffs as they continue to work their way through their systems. A strong dollar was actually a bit of a hedge against some of the tariffs, at least for U.S. consumers. So, we are starting to see the dollar pull back a little bit, and that's going to add a little bit of another aspect to consider for how U.S. consumers can weather um, potential tariffs. Gold pulled back a little bit to the $2,900 level here, but our upside target of 3,100 remains intact. Gold continues on its uptrend here, so a little bit of a pullback here is actually fairly healthy for continuation higher onto 3,000 and potentially 3,100 to the upside, which would obviously set a new record for gold. And oil has been stabilizing here around the $70 level here for the past couple of weeks. That is likely going to find a little bit of uh, a temporary support here and see even a little bit of a rally here in terms of oil. But overall, our outlook for oil remains fairly muted here and not expecting some big gains out of oil prices in the short run because of the a continued supply here in the U.S. remains incredibly strong, and global demand at the moment still is fairly weak here at the moment, and that dynamic combined with each other has led to oil prices being closer to the 52-week lows rather than the 52-week highs. And then when we look at kind of the overall sectors, we don't see a lot of sector rotation here at the moment. Predominantly, we continue to see, technology actually find a little bit of leadership here over the past couple of weeks after what has been a strong period of effectively no performance, right? Over the past month or so, we started to see tech that lag behind. We're seeing tech play a little bit of catch up here. Too early to tell if that catch up can continue, but certainly we would expect tech to potentially be a leader in the continuation higher here. Communications is another sector that has been incredibly strong here. As you can see, the incredible amount of outperformance in September out of the communication sector, as you can see, leading this market higher here, breaking out to new 52-week highs here, breaking out above the double top here a couple of weeks ago and breaking out again against a double top here just at the end of last week, a smaller double top. So combined with each other, those are pretty strong bullish signals here for the equity markets. Same thing here with financials breaking out above that $51 level, which is a double top level, which is a overall bullish signal here. And as you can see during that time, the financial sector is outperforming the S&P 500. Those are strong positive signals that we want to see here as equities break out higher. And on the flip side, you have consumer discretionary that has actually seen some outflow out of over the last month and a half. Consumer discretionary, one of the best performing sectors going into the end of the year, starting to lose a little bit of that steam here as more concerns around the pace that consumers can continue to spend. We see consumers remain incredibly resilient in a few specific industries, such as travel, but we have seen consumers pull back quite a bit here within other industries, luxury, um, home improvement, these types of consumer durables, these types of spending. We're seeing consumers be a lot more cautious in those specific areas, and that's leading to some losses here from a consumer discretionary sector overall. Industrials and energy are also two sectors that we continue to see some outflows out of. Industrials, as you can see, underperforming the S&P 500 by a pretty wide margin here since the beginning of December, as well as energy, which is not surprising, given that energy prices are closer to 52-week lows than they are to 52-week highs. Uh, Underperforming the S&P 500 by a pretty significant margin since the middle of last year. So that's where we currently stand from a sector rotation perspective. Now, to leave you with some ideas here for the week. Now, at the moment, what we've started to see here, I think probably a theme that's worth mentioning really is the themes out of the US. I'm sorry, out of China. We have seen over the last few weeks, China release a couple of things. One, after the announcement from DeepSeek R1, that really sent shockwaves around the U.S. tech industry. One of the things that we saw out of China was that this is really the first time we heard China from a more official standpoint provide support to the AI industry. We had President Xi a couple of weeks ago announce, up to about $160 billion of investment into AI, build out of AI infrastructure. That's the first time we've really heard of China discuss anything related to AI from a policy perspective at that high of a level. Prior to DeepSeek R1, we haven't really heard much in terms of China's plans with regards to artificial intelligence. So that certainly spurred on, a fair amount of relief from the NVIDIA sell-off because, if China is joining the arms race, if you will, that's going to be at the moment, at least for now, a net positive here for NVIDIA. And we have seen NVIDIA recover most of the sell-off that it had as a result of the DeepSeek R1 initial news. So the fact that China is joining the race with such strong numbers, I think, is actually a huge net positive for semiconductor stocks like NVIDIA. But the other thing is really China, having really struggled with economic growth here over the past few years, have tried many things over the last couple of years to restart economic growth. And all of those things so far up until now has largely uh, arguably has not provided the results that they were looking for. And it seems at this point, China is now turning back to its tech companies that it kind of, to some degree, from a regulatory perspective, made doing business much harder. Is kind of turning back towards these tech companies, both from a consumer perspective, but also from an AI perspective. This is the first time we've heard of China's from a CCP supporting Jack Ma, the CEO of Alibaba. Jack Ma has been sort of put to the sidelines for the last few years. We really haven't heard much from him. And the valuation of stocks like Alibaba have suffered substantially since that period of time. But it seems like China at the moment, out of perhaps you could call it a little bit of desperation, is turning to these tech companies to be the driver of an economic growth here. Alibaba trades at just around 10 times forward earnings, despite growing, at paces similar to Amazon, net margins north of, what we're seeing out of a lot of major retailers and tech companies here in the US. Um, Yet it trades at 10 times forward earnings, which is a very substantial discount to their US peers. Now, I don't expect these Chinese tech companies to trade at the same valuations that as their US peers. Um, one for accounting purposes, there's a lot of lack of transparency out of Chinese listed companies that we just can't make a fair comparison, apples to apples, to US tech companies. But so these companies do always carry a bit of a discount to what we would expect as normal valuations. But given the fact that Alibaba trades at such a low valuation, on this is the weekly chart here, and I've shown you many charts that look like this over the past few months, that have resulted in big moves here to the upside. And this is a weekly chart here. This 120 level has been an important level since the beginning of 2022. So the stock has failed to break out above 121, 2, 3, 4 times in the last 1, 2, 3 years or so. So we just broke out here to the upside. We have what looks like strong momentum and outperforming the S&P 500. And this, in my opinion, represents probably some of the biggest upside potential here at the moment for uh, for stocks here right now. So Alibaba is one of the stocks that we are adding to our bullish list here this week. Now, uh, so the next one I want to take a look at here is PDD. Now, PDD at the moment has, I think, some risks, but largely at the same time, the thesis um, for this particular stock is very similar to Alibaba from the perspective of the US. I'm sorry, China is turning to these major consumer and tech brands as the potential drivers for economic growth after a lot of other policies and ideas have largely, haven't reversed kind of the consumer spending habits out of China. So, China is turning to deregulating some of these industries and these tech companies and sort of unlocking shareholder value that has been locked away for many years out of these Chinese companies. So PDD, I think the biggest risk to PDD at the moment is kind of the ongoing trade wars with China and the US. There's one specific rule within US customs that allows and powers kind of these companies like Temu, which is the de minimis rule that allows companies like Temu to ship goods under $800 into the US without having to deal with customs and effectively makes Temu a strong competitor to Amazon. They drop ship out of China. But that's definitely one of the rules that are on review here right now as Trump looks at kind of a trade war with China. And if that rule were to change, it will obviously hurt US consumers, but it would hurt Temu arguably even more because that's their entire business model. It's built on the ability to ship goods into the US without having to deal with customs. So there, in my opinion, lays a fair amount of risk in this particular play, but the upside potential here is similar to Alibaba, meaning stocks like PDD trade at a heavy, heavy discount relative to kind of where they should be trading and trading at 9.7 times forward earnings versus the industry average is 22. So we're talking about more than 50% upside. I'm sorry, more than 100% upside. If you look at EPS and revenue growth, you're talking north of 30%, versus the industry average is around 10% and 5%. So you're talking about growth rates that are orders of magnitude faster than their peers. And then if you look at net margins, the industry is about 10%, net PDD is around 30%. So far more profitable than the industry. So, that's kind of why there's a sheer amount of a huge amount of shareholder value that can be unlocked here. But at the same time, there's some risk. But I think those risks, in the short run, if you're aware of them, might be worth it. Given just kind of the environment that we seem to find China putting themselves in to be more open to deregulating some of the industries that they've been particularly onerous on over the past few years and have caused a lot of these companies to trade at what are rock bottom valuations. And lastly, I'll bring you up to Baidu. Um, Similar type play here to Alibaba. Baidu, obviously one of the biggest players in terms of tech in China. As you can see, Baidu has been in this kind of down channel for a long time, and the question is whether the deregulation, or rather, you could say the unleashing of some of these tech companies from an AI perspective, would allow them to trade at a more reasonable valuation. If you think about uh, Baidu, it currently trades at around similarly 10 times forward earnings. The growth expectations for Baidu aren't that strong here. You're talking about 11% EPS growth, revenue growth. That's not more than 2-3%. So from that perspective, it is lagging behind the industry a little bit, but net margins of 15% does beat the industry by a pretty significant margin here. So the fact that it trades at more than a 50% discount, meaning there's more than 100% upside in the stock, even though growth metrics are a little bit slower than the industry median, the fact that it's far more profitable, I think, justifies it trading at a valuation closer to the rest of the industry, which, again, represents a significant amount of upside into kind of the low 200s for Baidu. And Baidu is definitely one of the leading AI players um, in the Chinese tech space. So I think that's probably the biggest shift in terms of new opportunities that we started to see here emerge over the last couple of weeks out of China, and probably the one worth talking about the most. Otherwise, the other one I want to take a look at here is Boeing. Boeing continues to look strong here. We talked about this kind of breakout here from 165, broke out here, came back to retest this as support, and now we've continued to make higher highs and higher lows, which is supportive of a continuation higher here for Boeing. They've been kind of heads down, focused on uh, raising deliveries and kind of getting through their backlog here. And I think we're starting to see the early signs of what could be a multi-year turnaround. And so far, that's looking at the moment still intact and looking fairly good. The other one, I don't remember if we discussed this briefly last week here, but Newmont Mining, as gold breaks out above that 2,800 onto potentially 3,100, Newmont Mining represents, in my opinion, one of the best valuation plays in the mining space. You have mining stocks that trade at pretty substantial discounts relative to the industry. Newmont Mining, I think, represents one of the best value plays, despite growing EPS and revenues kind of in north of 30 to 20 to 30%, and net margins that exceed the industry. The fact that it trades at a discount relative to the industry represents, I think, a fair amount of upside here for Newmont Mining, especially if gold can hold the levels that it's at and potentially break out higher. Newmont Mining does report earnings on Thursday here this week. And then lastly, I think NVIDIA is the one that I want to also highlight here. I think NVIDIA at the moment still represents one of the best most undervalued stocks in the US equity markets within mega cap names at the moment. NVIDIA trades at uh, 27, 28 times forward earnings, which sounds expensive until you look at kind of growth rates. NVIDIA is expected to grow top line by about uh, 65%. I'm sorry, bottom top line by about 57, 58% revenues, EPS by about 65%, right? So those are numbers that are sort of unmatched in the mega cap space, certainly in the tech space. Net margins north of 55%. So those are all things that are, incredibly um, uh, those are all trading at incredible growth expectations here. Yet it trades at 29 times forward earnings, which is I would say quite inexpensive given those specific growth metrics. So Nvidia, having struggled here over the last few months to gain any ground here, and if you can see it, it's been trading at the same price that it started trading at back in June. I actually think that that represents a pretty substantial upside because the landscape of AI and what we expect these major tech firms to spend on building out AI infrastructure in the last 6 months have, the outlook of that has improved substantially. Yet the stock is still at the same price it was 6 months ago. So I think from that perspective, there's some catch up that the stock needs to do to the reality of the fundamentals here right now, which, especially with China, now starting to join the AI arms race, is only going to heat up and actually benefit stocks like Nvidia. So while the stock sold off here on the back of the DeepSeek news, I think that was a buying opportunity. And I think for long-term investors, still, Nvidia still represents one of the best value opportunities here in the market right now. So with that, that kind of gives you a wrap of where we currently stand here from a equity market perspective. Hopefully, this gives you a clear understanding as to how we're viewing, where equities are on the verge of potentially a breakout here. It's important to watch that here over the next couple of weeks, especially we want to make sure we don't just get a false breakout that kind of ends up trapping investors and pulling back into the trading range. We'll keep an eye out for that. Overall, there are some positive signs here for the US equity markets, and then we can see some growth here out of the Chinese stocks specifically at the moment that I think are worth paying attention to right now because we could be on what could be the start of a big move here in Chinese stocks over the next year or so in 2025. So with that, hopefully that that's helpful for you and gives you a good way to start your week. So thank you so much for your time here, and I will see you guys here next week.